Hello, good morning. You're watching Market Cafe on ET now with me, Vinny Motiwala, along with me, Ankita Saxena as well. Ankita, very good morning to you. And how are the markets looking like in terms of the US? What's the handover that we've actually gotten from the global markets? Anything exciting or just a dull day again?
Good morning to you, Vinny, and good morning, everyone. But the US markets were a little dull yesterday. They closed mixed, but nothing really, no direction coming in there. And of course, that is probably because we are really awaiting the big CPI and the PPI number that's likely to come out of the US. The US markets, like I mentioned, closed mixed ahead of the March inflation report. The CPI is estimated to rise 0.2% in March as compared to 0.4% gain in the month of February. Now that number is going to come out today, and of course we will bring you all the details tomorrow morning. S&P 500 closed a little changed, absolutely flat. The Dow Jones Industrial Average gained 0.2%. However, the Nasdaq Composite lost 0.4% in trade. We also saw Nasdaq lost in a day prior session where, of course, the tech stocks took a beating. Now, minutes from the Federal Reserve's March policy meeting are also likely to come out. Corporate earnings, of course, have kicked in full gear this week with reports from major banking giants. And of course, the IMF has also come out with a commentary that says the global economy is heading for the weakest growth since 1990. On the back of these all the news flow that's coming in, the stock futures, as I see, are absolutely flat, though with a positive bias. Let's look at the European markets as well. European markets closed higher after 3 straight sessions of marginal losses last week. Mining stocks led the rally. DAX was up 0.3% in trade. Stock 600 was up 0.6%, and FTSE was up 0.5% in trade yesterday. Vinny, tell us where the crude is at.
Absolutely. Let's just highlight it because Brent crude oil prices have actually gone up again above that $85 per barrel mark as well. Overnight, it did rally as much as 2%. This morning, it's opened up with slight bit of gains as well. So, green coming in there. Brent crude oil prices closed actually at the highest levels that we have seen coming in since late of January. And mainly, what is it? Buoyed by the prospects of higher Chinese demand, tighter global supplies are the factors that are leading to higher crude prices. Even WTI crude oil is trading higher in trade as well, above and around that $81 per barrel mark as well. So let's keep an eye out on that. Even we're waiting for the US inventory data that will be coming out as well. So that is keeping crude oil prices on the radar as well. Also, Ankita, let's just talk about some of the important events. You did highlight the Indian industrial production, that is the IIP data, CPI data that will be coming in India. And on the global front, we do have the FOMC minutes, which is important to watch out for as well as the US CPI data coming in as well. Domestic front, earnings season is starting, and obviously going to kickstart the earnings season with TCS in the Nifty front. So keep an eye out on TCS. The company will be reporting their numbers today. In other than Nifty, we'll be watching out for Anand Rathi Wealth also, which will be reporting its numbers. Other than that, in terms of some of the corporate actions that we should be watching out for, one, we have Vardhaman Special Steel. The board meeting is going to be today to consider issuance of bonus shares. Emami considering will be a buyback ex-dividend date today, as well as listing of new shares of Suzlon Energy is something that will be happening as well. So keep an eye out on all those corporate actions as well.
All right, then we will be keeping an eye out on all those corporate actions and, of course, the global news flow that is going to come in tonight. Important data numbers coming out of India and the US markets as well. But let's quickly look at the news that made headlines overnight. Well, the International Monetary Fund has cut the global GDP forecast by 10 basis points to 2.8% in its World Economic Outlook report for 2023. Now, this is on the back of interest rate hikes by the central banks around the world and the recent volatility in the financial markets. The international body also cut the GDP growth forecast for 2024 to 3%. Now, similarly, the committee slashes India's GDP growth forecast for 2025 financial year by 50 basis points to 6.3%. Listen in to an excerpt from the presser.
That pent-up demand, which from consumption that was informing our previous forecast, is therefore going to be less because they've already had more catching up before. So that's why there's the downward revision this year. Then we go up to 6.3 next year. Again, a very strong economy, which is necessary to allow India to continue to converge towards higher living standards and create those jobs that are necessary.
And let's move on and talk about New York Fed Chief John Williams, who said that the policymakers have lots to do to bring down the inflation. He further added that the March outlook of policymakers for one more interest rate hike this year, as well as followed by pauses. Now, reasonable starting place is what he called, though the path will depend on incoming economic data as well. Even as inflation shows signs of a cool-off, it continues to be well above the Fed's 2% goal. So that is the word coming in from John Williams.
And ahead of the World Bank meeting, US Treasury Secretary Janet Yellen highlighted the recent data that said that the US economy is holding up even as the Federal Reserve continues its battle against inflation. She says, and I quote, "The US economy is obviously performing exceptionally well with continued solid job creation, inflation gradually moving down, robust consumer spending."
And all eyes on the much anticipated March inflation print from US, which is expected to slow both monthly and yearly. While the core reading is also expected to ease mildly on a month-on-month basis, the annual inflation dipped to 6% in the month of February from 6.4% in the month of January. Now, markets, the figures will actually set the Fed in motion and will be one of the key drivers for them to actually start deciding whether there'll be any furthermore rate cuts or rate actions coming in as well.
And the International Energy Agency has called OPEC Plus's production cut a risk for the global economy. The move, he says, will push up prices, leading to higher import bills. He also expects prices to move higher from current levels.
And US President Joe Biden has arrived in North Ireland's Belfast ahead of the 4-day historic tour. His visit marks the 25th anniversary of the Good Friday Agreement, a peace deal which helped end 30 years of violent conflict with Northern Ireland.
And social media platform Twitter has ceased to be an independent company. The platform is now a part of Musk's newly formed shell firm X Corp. Now, in a court filing, Twitter disclosed that its assets have been merged with X Corp.
And Berkshire Hathaway's chairman and CEO Warren Buffett raised his stake in Japanese firms, signaling further increase in his holdings in future. The move sets select Japanese stocks to soar on the back of this news. These range from the likes of Mitsubishi Corp, Mitsui and Company, as well as Itochu, Marubeni Corporation, and some other names coming in as well. Now, Buffett has raised the stake in all these trading houses to 7.4%.
And well, with that, it's time for us to slip into a short break. Don't go anywhere. We go domestic after the break. Of CEO at Work, our managing editor Nikunj Dalmia caught up with the MD and CEO of Axis Bank to catch the full conversation, but here's an excerpt.
While growth is enviable right now, but the deposit growth is something which is, I won't say pathetic, but it is slightly poor. The gap between deposit growth and the credit growth, I guess, is the highest in last 10 years. Do you see that gap narrowing down, which means growth has to come down or deposits have to go up?
Well, it is narrowing down. You've already seen the credit growth come down a little bit in the last couple of quarters. We are predicting the credit growth to be in the 13 to 14% range next year. The deposit growth is obviously muted. This is not sustainable in the long run, that you have a jaw which is negative. The deposit growth should be slightly higher than the credit growth. So at some stage it has to turn. Hopefully some of the changes that have happened in the budget will support the deposit growth in the banking system. Our view is, and as you would see, while the bulk deposit rates had caught up with the increasing interest rates earlier, even the retail deposit rates, if you look at the retail deposits rate today, they've already reached the peak of the last cycle. Today, for example, Axis Bank is offering for 1 year 7.26%. The peak of the last cycle was 7.3. We're already there. So I do expect that in the system it might take a couple of quarters to play out, but hopefully people will see value in putting money back into the banking system and the deposits, because some of the alternates might be as expensive or giving the similar returns as what the banking system is giving. And if it does not happen, well, at some stage the credit growth has to be tempered. There are no two ways about it. But all of us are also at the same time ensuring that we are expanding our physical infrastructure. We are spending a lot of money in digitally also, so that we can reach out to more customers. And as that happens, hopefully that will continue to give a fillip to the deposit growth. But right now, deposit growth is a problem in the system, and we do need to solve it. We need to get it back. Otherwise, at some stage, it will hit our ability to increase the credit growth.
So are you rejecting more loans and giving approvals for less loans?
We are very clear that the loan has to come at the right price and the right risk-adjusted return on capital. That's why if you look at Axis Bank's performance, you will see that on the large corporate side, our credit growth was limited because we were not getting the right price. Now, in the last couple of quarters, we've seen the price come back. You will see that our loan growth is also kind of picked up. So we are quite clear that we need to get the right return for the money we are giving out in the marketplace. That does not mean that we don't do fine pricing, but the overall mix has to make sense to us. And we have worked very hard to get our net interest margins from where they were to where we are now. We would like to maintain them in the same zone rather than just in the desire to get growth, giving it away and unnecessarily putting pressure on ourselves. So we have created the right operating leverage. We would like to maintain it.
You did get an advantage in last 2 quarters because of the interest rate cycle. What would be the lever for Axis Bank going forward to maintain and expand margins?
Well, beyond a point, just expanding margins does not make sense. So as we have said, in the long run, we wanted our margins to be around 3.8% and above. We've already reached 4.2% if I take out the one-offs. So we are already above the zone. So I have some margin to play with. And our view is that we will work very hard to ensure that we remain in that same zone.
That was the management of Axis Bank for y'all. But on that note, we're going to step into a very short break, viewers. But here's the news for the hearing.
Okay, now let's begin with the news on the domestic front. On the sidelines of the AIMA event, my colleague Sumita Karir caught up with Sanjeev Sharma, who's the country head and managing director of ABB India. He says that the company's margin trajectory is on the upswing. Listen in to this piece of the exclusive conversation.
ABB in India is manufacturing for the last 75 years. And, we have 27 factories, 18 businesses, and all of them have a very deep manufacturing footprint in the country. And so is our supply chain also is built inside the country. So as we go forward, as India becomes more and more demanding for reliable and, high quality products, it will continue to deepen.
So talking about supply chain shortages, chip shortages as well. Now this is something that a lot of brands have spoken about, that chip shortages have not really receded, have not really eased. What's your take on that, and how is that going to impact your business?
Being a multinational corporation, we are part of the global supply chain network. So we do get our allocation of our components, including chips. So what we do is we are able to meet the demand in the marketplace, but we are committing to the demand we can deliver.
Right. So any word on margin trajectory that you can share?
Well, if you look into our trajectory, in last many quarters, I think it's on the upswing. And we're very encouraged with the volumes that we are getting in the market and also our ability to deliver to the customer. And naturally, our backlog is much higher than before. So when we go forward and execute it, it will show up in the margins as well.
Also, Sumita did catch up with Sanjeev Sanyal on the sidelines of the same event, that is AIMA as well. Let's go across and listen into the snippet of what he's expecting in terms of India to grow at.
See, it's quite obvious that the world economy is under stress for a variety of reasons. The lagged impact of monetary and fiscal policies that had been done during the COVID period, a lot of which, by the way, we in India had warned against. But anyway, that's there. There's, of course, the war, uncertainties in East Asia, and I think OPEC's rather irresponsible cut in production. All of this means that we live in a somewhat uncertain world where not only are financial systems under stress, but the real economy in many cases is slowing down. So given that that is how it is, I'm not surprised that multilateral agencies have cut their forecasts. And in that context, there have been some cuts in our own forecast. It's still within the range of what the economic survey had forecast, So I still think we'll grow at about 6.5%, which is not it's not a trifling achievement given the context that the world is growing at 2%. We'll be growing at more than 3.5 times the world average. So in that context, I think we are doing rather well. But yes, if we have better external conditions.
But talking about rate hikes, the RBI MPC has paused hikes. But for how long do you think that is paused, and what do you see the way forward for it? Although it's said that it cannot define the path for the future. But what do you make?
Well, I think the Reserve Bank was absolutely correct. It gauged correctly that the impact of past hikes is still to flow through. We are right now at the very top of the band, so it's not like we are far off the band like in many Western countries or in Argentina or Pakistan or some such country. We are at 6 or thereabouts, a little above 6. So we are in that range. So given that we are not off kilter, I think there is a case for holding our horses and letting the old hikes feed through. The WPI, as you know, has come off significantly. So I don't think there's any galloping inflation in the system. There are pressures, a lot of it imported from oil prices, as I said. But so I think the RBI has been correct in its assessment in doing a pause. And my own view, by the way, is even the West will find it difficult to maintain further tightening. Their financial system clearly is under stress. So I don't think they are themselves in a position to really tighten much more.
And well, my colleague Sumita also spoke exclusively to Rajiv Bajaj, the MD of Bajaj Finserv, who is seeing the RBI rate hike pause as practical. Let's listen in to this slice of that conversation.
We see this rate pause as something that RBI is doing in a very practical manner by actually watching how events are unfolding on ground and also globally and taking an appropriate action. Because while RBI needs to control inflation, it also clearly understands that it needs to balance growth. And that's why we saw the statement that we did from RBI along with this rate pause. We're still living in a world that is going through a significant amount of uncertainty. But we are also seeing stable and a growing economy domestically. And this is the balance that we need to achieve.
And secondly, sir, I want to ask you, you've done incredibly well in the sector of finance, but where do you see the newer avenues come? Where do you see growth coming in? Because, each passing day, more and more players are disrupting the ecosystem, coming into the ecosystem.
At less than $2,500 per capita, India is just about at the cusp of secular growth for the next 20, 30 years. The government is playing a significant role in the last few years when otherwise things have slowed down with their investment in infrastructure, public infrastructure. And this will have a multiplier effect on creating new jobs, on creating new consumption. If you look at Bajaj Finance, a player that is now reasonably large over the last decade, we are still less than 2% of the banking sector. We are present also in 4,000 cities and towns around the country. So we believe that we need a lot more healthy competition. We need to see financing, insurance, investing all over the country. And we believe the digital world allows for that limitation that used to exist in the physical world to no longer be there. And it's going to be an interesting business to be in.
Okay, and let's shift gears, talk about earnings seasons that will be kickstarting today with the IT company TCS. Now, are the margins for IT companies in the recovery mode for the sector? And is the worst actually behind them? TCS and Infosys will obviously start this earnings season. Today it's going to be TCS. Let's get in a lowdown on what should we be expecting from IT companies, TCS, Infosys and others from Anisha. Anisha, take it away.
Oh, well, yes, IT sector is all set to start the earnings season. We'll get the numbers from TCS post-market, so that's the key talking point in the market. But as you pointed out, it's a seasonally weak quarter, and this time around the revenue conversion has been slower than usual, and that's because there has been a macroeconomic slowdown across the board. So the deal signings have been a tad bit delayed, and the revenue conversion too is a tad bit slower, and that's why we are going to see very tepid growth on the top line across all IT companies. If you look at the expectation as far as the constant currency growth is concerned, it's TCS which is likely to lead from the front with a growth of almost 1% coming in. But then there are a couple of companies like TCS as well as Wipro which are likely to perhaps report a bit of a decline when it comes to the top line in the quarter gone by. So that's something that we are watching out for, and Tech Mahindra too is expected to be tepid. As far as the margin profile is concerned, we are expecting some sort of improvement there across the board. It will be larger in the mid-cap companies, but even for the large caps, There is going to be improvement of around 40 to 60 basis points when it comes to TCS as well. Infosys too is expected to report healthy improvement in margins, and that will be driven by improvement in utilization. We know that in last year there was a lot of headcount and fresher addition that had happened. That will start participating into the revenues this time around, and that's why the margin is expected to be better. Plus the currency tailwinds this time around is at a 10-quarter high, so that is something that will again support the margin profile of all the companies going forward. But the key, of course, this time around will be on the expectation of how FY24 is likely to pan out, because double-digit growth was a given in FY23. Whether it will continue in FY24 or not is the key talking point. The expectation is it's not going to continue. For Infosys, for instance, we're expecting that the revenue growth guidance will be around 5 to 7% with a margin band of 21 to 23%. For HCL Tech, 2 or 6 to 8% growth will be something that the street will be okay with. The margin is expected to be around 18 to 20%. So very similar to what they did in FY23 itself. For Wipro, there could be a guidance of Q1 FY24, which might, tell you about a decline of 1% to a growth of around 1%. So a bit of a broad range coming in. And of course, with respect to TCS as well, it's expected that double-digit growth will not continue, but single-digit of around 5 to 8% is what is expected. Having said all of that, the valuations have become a lot more comfortable. Remember, during the peak times, we had seen the multiples going as high as 30 to 34 times. It's come all the way down to around 24 times as of now. While if you look at the 5-year averages, the likes of TCS and Infosys are trading below the 5-year averages, while a couple of them, HCL Tech, Tech Mahindra, etc., are very close to the 5-year averages. So a lot of decline from the highest point of the multiples, but in line with what we have seen over the 5-year as well. Specifically talking about TCS as well, with the numbers are expected. TCS is likely to lead the revenue growth with a number of around 1.1% on the top line. Margin expansion to 40 to 60 basis points. But the eye would be on the management transition, the headcount addition, as well as the possibility of buyback, because ICICI Securities there is expecting a 20,000 crore buyback. So that is something that I'm watching out for.
Well, TCS earnings expected as of today. And let's go across and listen into what the analysts have to say about the earnings.
As far as this sector pricing of this, there are order wins in past which will definitely support the revenue this time, and margin is also expected to expand sequentially because of the lower cost pressure. Attrition already started declining since last 2 quarters, so that should help. And also other cost parameters are also in control in terms of net employee addition. Last quarter was more or less flat. This time also we expect net addition of employee would be largely flat sequentially. So margin expansion is expected for across the companies, and revenue would be more or less flat to marginal growth, with probably TCS would be reporting one of the highest growth of around 2% kind of a sequential growth.
Move is to join the security alliance was precipitated by the Russian invasion of Ukraine last year and changing nature of the international geopolitics with a declining Russian influence. Now, Times Network Srinjoy spoke exclusively to the deputy head of a mission at Finland Embassy, Dr. Tito Gronov. Let's go across and listen into this conversation.
Well, it means that we have more security. The Article 5 of NATO gives us security guarantees. And I would say that we have been sleeping well, but now we will sleep even better. Well, NATO membership is not just something, a coincidence in Finnish history, but it's a logical continuation of our previous history. Well, we joined the European Union in 1995, and already then there were some voices suggesting that we should be a NATO member. Well, there was also opposition, but the Russian attack against a neighboring country, Ukraine, was the trigger really that changed the situation, and the very large majority of Finnish people actually, out of 200 members of parliament, only 8 were against or absented the vote at the parliament. So we are very much in favor of NATO, and very grateful also for the other NATO members to ratify our membership. We are counting also on good cooperation in the future, and we can also contribute to the NATO with our relatively strong armed forces.
What do you expect the Russians to do now?
Well, I'm not a military expert, but some experts suggest that there might be some hybrid measures against Finland, such as cyber attacks against our institutions. There might also be some propaganda and other measures, non-military measures.
Finally, Sweden and Finland both wanted to join NATO. Finland certainly has. Sweden has not. And this is because there are countries within NATO who, at least for now, have opposed Sweden.
Well, that's unfortunately very correct, and as a new member state of NATO, Finland will also work for the Swedish membership. I hope that it will happen as soon as possible. It's very important for us to have Sweden in NATO due to logistics, and we also have a very good old cooperation between Finnish armed forces and Swedish armed forces. I hope that it's just a question of time.
And well, with that, it's time for us to slip into a short break. But before that, let's quickly take you through the stellar lineup that we have on the market. At 8:45 a.m.,
let's shift focus to IndusInd Bank and the shareholding disclosure that is coming in there as well. Now, the bank's FII holding has actually fallen below the minimum requirement to be included in the MSCI index. What does this actually mean for the company, for the stock? Let's go across to Somit to understand this. Somit, what is this indication actually coming in when IndusInd Bank shareholding disclosure is actually indicating that FII's holding has fallen below the minimum requirement?
Well, as the MSCI May 2023 review comes near, a lot of stocks continue to remain in focus, and today in focus is IndusInd Bank. Now, according to the latest shareholding disclosure that they have done on the exchanges, what we are understanding is that the FI holding, including the promoter holding in IndusInd Bank, has declined to around 63.5% from around 65.9% that we had seen in the previous quarter. Now, despite this sell-off in the FI holding in IndusInd Bank, the investment headroom stands at only 14.9% as per IIFL. Now, for MSCI for a stock to get included in the MSCI index, the minimum investment headroom needs to be around 15% or more than 15%. Now, given the fact that IndusInd's FI investment headroom is below that number, we can say that the stock won't be getting included in the MSCI index in the May 2023 review. So that is the stock that remains in focus. Now, apart from IndusInd Bank, a host of other stocks also continue to remain in focus on the back of this MSCI May 2023 review. Firstly, it's Kotak Mahindra Bank, which is expected to see an increase in weightage, which could lead to an inflow of close to $700 million US. Then there is ACC, in which there is a possibility of the stock getting excluded if it continues to trade below the 1,730 rupees mark. Hindustan Aeronautics is one stock that has a high probability of inclusion, while Indus Towers has a high probability of exclusion from the index, while Power Finance also continues to remain in focus. If the stock continues to trade above the 160 rupees mark, then there is a high probability that it might also get included in the MSCI index in the May 2023 review.
Well, thank you for those details, Somit. And we'll move on and go stock specific and tell you all the stocks that you need to keep on your radar in today's trading session. And for that, we have Ashesha in the studio with us. Good morning, Ashesha. Do tell us what are the stocks that we need to keep an eye out on?
Hi, good morning. So earnings season has begun and Delta Corp will be the first one in focus, and that will be on the back of results that the company reported yesterday post market hours. It was a weak set of numbers. Slower revenue growth and higher expenses has impacted financials of the company this quarter. Revenues have grown a tad bit by about 4% on a year-on-year basis, but margins have been impacted big time this quarter. Company has reported margins at 26% in the quarter gone by versus margins at 31% same time last year, indicating a contraction of about 500 basis points on a year-on-year basis. Apart from that, HDFC Bank will also be in focus, and that is on the back of their fundraising plans. They've said that they will be raising about 50,000 crore rupees in the meeting that is scheduled to happen on 15th of April. This will be done via perpetual debt instruments, tier 2 capital and long-term loans. So on the back of this fundraising plans that the company has informed about, keep an eye out on HDFC Bank as well. Moving on to BHEL and Titagarh Wagons, and a consortium of BHEL and Titagarh Wagons has won a big order from the railways. Order has been given to supply 80 trains, which will be done at a rate of 120 crore per train. So on the back of this win, keep an eye out on both these counters. Moving on to Sula then, that one will be in focus on the back of their operational updates, where own brand revenue has seen an uptick of about 15% on a year-on-year basis, while wine tourism revenue, this particular segment has seen an uptick of 18% on a year-on-year basis. Lastly, Sagar Cements, remember this particular counter was in focus yesterday. It nearly gained 8% in yesterday's trading session, and that was on account of a big block deal that took place. ICICI Prudential Mutual Fund bought about 60 lakh shares at the rate of 183.1 per share yesterday. Meanwhile, PGIM India Mutual Fund sold 60 lakh shares on account of this block deal that took place yesterday. Keep an eye out on this counter in today's trading session as well.
Okay, Ashesha, thank you so much for that. But other than that, let's just keep an eye out on Reliance Industries. And what's coming in here now is that it is actually looking to unlock value in the warehousing and logistics space. Now, the company is planning to implement an infrastructure investment trust, or as we know it, it's an InvIT. And company's retail arm has already started on the groundwork for the proposed InvIT for its warehousing assets after it has already registering the trust and with the market regulator by the name of Intelligent Supply Chain Infrastructure Trust. Now, the sources claim that this trust will house the warehousing assets that the group plans to monetize going forward as well.
And well, Landmark Cars held its analyst meet recently, and Antique expects moderation in the ASP growth and believes that 20% ASP growth is sustainable. My colleague Vamakshi is here with us with all the key takeaways from the analyst meet. Vamakshi, do take us through them.
Well, good morning to all of you all. We did see that Antique met up with Landmark Cars, and they've highlighted that the company is continuing to focus on the premium products and it will not get into the mass segment is what the company believes. Now, over the years, the company has grown both organically as well as inorganically, and they want to continue with this strategy. Now, they recently acquired a Mercedes competitor that is based in Mumbai and looking at some inorganic opportunities by taking over the business of local competitors. They're expecting a decent top-line growth to come in, driven by increase in the average selling price of premium cars and growth in service revenue. However, going ahead, they are expecting a bit of moderation in the average selling price growth going ahead, but nevertheless, they believe that 20% ASP growth is sustainable. The spares and services revenue is also expected to do well for the company, and in fact, currently they finance nearly 75% of the cars, and they're definitely looking at the finance and insurance space as a good opportunity. They're looking quite optimistic on the used car business as well, and in fact, they're looking forward to integrate the same into its existing dealership network and also not have a separate setup for this. Honda is also expected to do well going ahead, and this is important because Landmark Cars is a leading dealer for Honda, and in fact Honda is expected to achieve a volume of 1 to 1.5 lakh units with its new SUV launch. So a positive outlook coming from Landmark Cars.
Okay, Vamakshi, thank you so much for that update on Landmark Cars. But Ashesha, coming back to you, steel stocks, what's happening in this space? Why are they in news flow today?
Well, yes, this counter will be in focus today, and that is because JP Morgan has come out with an interesting note. First up, they're talking about steel price hike. Remember, steel prices have risen nearly 30% year to date, and now JP Morgan believes that perhaps we will not see any further price hike, at least in the domestic market. As far as coking coal prices are concerned, they say that coking coal prices have declined nearly 25% from their February 2023 peak, which means that spreads have now increased because steel prices have risen, but coking coal prices have not risen correspondingly, and hence they believe spreads could now increase. Implied spot steel prices are now back to normalized levels of about $200 per ton. They say that they expect coking coal prices should fall further. Coking coal prices, coking coal, remember, is the largest cost component in steel manufacturing. Domestic demand is running strong and exports are at healthy levels, and hence for now they say Chinese steel demand will be the key factor to watch out for as far as the steel market is concerned. For now, they believe that domestic prices are not expected to increase as far as steel prices are concerned, but coking coal prices are off from their peak, and hence spreads are expected to remain at elevated levels.
Okay, Ashesha, thank you so much for that update coming in. But let's just talk about one more stock that has actually touched an all-time high recently, and that is L&T. It touched a 52-week high of around 2,330 rupees on 11th April. That's just yesterday. What are the key triggers? Why was it actually buzzing in trade? Let's not forget the strong capex push that L&T has been getting from the government, and the capex spending to aid orders revenues for the company. Other than that, the strong order book for the company is also standing at around 3.86 lakh crore rupees, which is 2.2 times on the trailing 12-month basis. Other than that, the revenue capex is something that we are watching out for as well. The capex traction from oil exporting countries, that is a key trigger for them, as well as the competing to build a 42,000 crore ICTP in a Great Nicobar are some of the key positive triggers that is coming in for L&T. Other than that, a risk that one should watch out for in terms of L&T will be the potential slowdown or delaying in terms of any orders. Also, in terms of Q4, what we're expecting from capital good companies, a healthy Q4 number is what we're expecting from capital good companies. Strong order book, continued execution momentum, better demands, orders from domestic as well as export markets. So that does work out well for L&T as well, and especially strong growth of 40% in terms of year-on-year basis for new projects is what we're expecting overall in the cap good space as well. Especially when you talk about L&T, infra thrust, like I mentioned, capex revival in the private sector. Other than that, they expect to meet the FY23 order book guidance of 15% on a year-on-year basis. That's the word coming in from analysts as well. So surely keeping an eye out on this one. When you look at in terms of the valuations, look at L&T's valuation, 23.6 times FY24 PE compared to a Siemens, ABB, Thermax, which is much higher than that. About they are in the range of that 44 to 50 times mark as well. So surely cheap in terms of valuations compared to other cap goods as well, Ankita.
All right, then Winnie, some more stocks to be spoken about as brokerage notes have been coming in, and Vamakshi has been going through all the brokerage notes that came in this morning. Vamakshi, tell us what are the brokerage notes saying? What are the stocks that we need to keep on our radar?
Well, let's first kick off with L&T itself. Since we were just discussing it, we have a note that has come in from JP Morgan, and they've highlighted that the capex cycle is looking quite strong for L&T. In fact, the FY23 order inflow beat that the company saw is already in the price. But nevertheless, going in FY24, the core revenue guidance is expected to be quite robust. The stock has outperformed in 4 out of 5 times pre-elections, and they've also gone ahead raised the core multiple at 21.3 times FY25 estimates. So given all those positive factors, JP Morgan has maintained its overweight rating on L&T, target price of 2,480 per share. We also have SBI Life on our radar. We have a note that has come in from Goldman Sachs. They've definitely lowered their FY24 and 25 APE and VNB estimates by around 7%, but nevertheless, they do like SBI for its leadership in both the market share as well as profitability. In fact, they've gone ahead and said that their FY24 and 25 estimates in terms of VNB are actually 7 to 11% above the consensus estimates. Nevertheless, they've reiterated the buy rating on SBI Life. It is on their conviction list, and in fact, they've also revised the target price to 1,520 per share. And lastly, watch out for the NBFC sector. Citi believes that NBFCs, being wholesale borrowers, should react positively to changes in the rate outlook. They believe that it is now a different time for NBFCs in the sense that not interest rates, but the competitive as well as the regulatory fears are dragging the performance. Cholamandalam and Aavas Financiers are the top picks. They see intensified competition in core product segments, and they believe that the rate pause could incrementally provide confidence on the NIM trajectory.
Okay, Vamakshi, thank you so much for that. And those were the brokerages that we are watching out for this morning as well. But overnight, we did get some commentary coming in from the IMF chief as well. And, after lowering the global growth forecast, the IMF chief economist Olivier Gornakis told Economic Times in an interview that India is close to its potential output, leaving less room to accelerate growth. Now, he added that India needs to boost investment in infrastructure, healthcare, and focus on access to education. The IMF has projected a slowdown in India's GDP growth from 6.8% last year to 5.9% now, followed by the rebound to 6.3%. He also said that he sees no risk of a global spillover of the US and European banking crisis yet.
And well, with that, it's time to wind down on this one. Thank you so much for tuning in. Don't go anywhere. The markets will take the action forward.